Hi, I'm Jim Epley, President of JDsTax and Financial Solutions. Today I'm going to teach you a little bit about insolvency and how it relates to the Mortgage Forgiveness Debt Relief Act of 2007. Now that's a tongue twister. That's a law that took effect in 2007 and it expires at the end of this year, December 31, 2012. What that law allows is if you have cancellation of debt from your home foreclosing or doing a short sale, you can get out of paying tax on that amount. So let's say you owe $200,000 on your home and it short sells for $100,000. The bank is going to send you a form for $100,000. Normally you report that on your tax return as income. But with this law that's in effect right now, it expires December 31 of this year, 2012. You can put that on your tax return and then we can, in essence, back it back off the return so you don't owe tax on that $100,000. Question is, what happens next year? That law is going to expire at the end of this year. So I'm going to teach you about insolvency. And what insolvency means is that your liabilities or your debt is greater than your assets, which is what you own. So I'm going to take you through an example here and hopefully you'll get something out of this. So we're going to assume your assets are your home that's worth $100,000 in today's market. You have your automobile, it's worth about $15,000. You have your 401k plan, there's $15,000 in there. Your furniture is worth about $10,000. You've got your clothing worth $3,000. Other miscellaneous household items, $2,000. So your total assets are $145,000. That's everything that you own. Now we go over to the liability side. This is everything that you owe. This is your debt. So your liabilities, you've got a mortgage of $250,000. And that's about average in today's market with your home worth $100,000. In addition to your mortgage, you have an auto loan of $20,000. You also have credit card debt of $30,000. So your total liabilities are $300,000. So if we take the $300,000 and we subtract out your assets of $145,000, that's $155,000 of insolvency. So what that means is if that home that you owe $250,000 on, you sell it in a short sale for $100,000, the bank is going to get the $100,000, but they're going to be shortchanged $150,000. They're going to send you a form at the end of the year that you owe tax on that $150,000. Now if we can prove insolvency to the tune of $155,000, you'll owe zero tax on there. So hopefully this was helpful for you. If you have any other questions, please feel free to call me at 702-639-9130. Thanks for listening.